Today, we are diving into our options bootcamp part 1 here. Now, options it's something that I feel like a lot of traders are wanting to learn as we move into 2023, as we move into 2022, 2021. I remember when I first started trading, everyone just wanted to do penny stocks. Penny stocks, penny stocks, penny stocks. Because the thing is, when you learn about penny stocks, you can have a small amount of money, you trade small amount of shares, and you can buy a lot of shares, you could buy a lot of shares off these small price tickers, and they go on big spikes, big rips, big runs. As we moved into, let's say, later time frames such as 2021, 22, 23, a lot of people have found a lot of success in option trading. Now, I'm going to tell you guys this right now. There is no right, there is no wrong. As in, if you guys just want to trade penny stocks, go ahead and just trade penny stocks. If you guys want to trade options, just go ahead and trade options. But find what works best for you. I like learning about all these different strategies. I like learning about options and penny stocks, and I want to learn more about futures. And I like learning about blue chips and swing trading and shorting. And I like learning about everything because I want to have all these tools in my toolbox so I can be able to trade every day, no matter what the market presents itself with. So let's break this on down and let's make this as easy as possible. I'm going to assume that the person listening to this right now knows nothing about options, so I could take you from 0 to 100, A to Z, and make sure that you know exactly how to be following along and to be able to make your first options trade coming on up. So first thing that we definitely want to be talking about are, what are options? Well, an options contract is a contract that allows but doesn't require an investor to buy or sell an underlying instrument like a security, ETF, or index at a predetermined price over a certain period of time. Buying and selling options is done on the options market, which trades contracts based on securities. Buying an option that allows you to buy shares at a later time is called a call option, whereas buying an option that allows you to sell shares at a later time is called a put option. So the easiest way to be able to remember this and the easiest way to think about it is we are going to have shares where you can go ahead and buy shares, and you are going to have options and these option contracts. Think about it like this for now on. You can go out and you can go buy a car. And let's say we go out and we buy a supercar. We buy a Lamborghini. We can go ahead and we can spend $250,000 on a Lamborghini. That's a very big sum of cash that we go ahead and we spend right away. Or we could go ahead and we could lease that Lamborghini. But the thing is, we don't own that Lamborghini then. But if I lease the Lamborghini, I can still have fun. I can still drive it around. I can still, keep it in my garage, but I only have it for a certain amount of time. At some point, I have to give it back. At some point, it's not mine anymore. So that's the difference between, let's say, shares and options. Shares you can hold forever. You could buy an Apple share right now, 1 share, 2 shares, 10 shares, and you can hold it the rest of your life. And by the time you're 65, by the time you're 70, you can say to yourself, hey, let's see how much money you've made. But as an options, there's an expiration date, and you're essentially just leasing out the shares. So how can this make us profit? Well, if we lease these shares, which says we can hold them from this time frame to this time frame, and they gain value, when we give them back, we are now able to make a profit. So let's go right here. What are the options different? How do they differ from stocks, from futures? Well, options are not the same thing because they do not represent ownership. You do not own a contract. You only have that contract forever how long you choose until your expiration date. Futures use contracts just like option dues, as options are considered lower risk due to the fact that they can withdraw or walk away. The big difference between futures and options is going to be that options have time decay, which is one of the toughest things to overcome and learn how to deal with time decay. Futures, one of the big pros about that is they do not have time decay, which is why a lot of traders have actually been moving into futures after learning about options, which is something that I definitely want to start exploring more as we head into 2023. So right now, we basically have a very simple understanding about options. What's the difference between options and shares? Options expire, and again, shares do not. The other way that you can think about it is on a contract. Contracts use leverage. So has anyone ever raised their hand and said, Deck, I don't understand how you're making so much money with options, but I'm not making as much money with my shares? Deck, we have the same account size. I have 10,000, you have 10,000. How did you just make $2,000 today? I put money in shares and I only made $200. Well, team, when you buy a contract, your options use leverage. And usually what it comes out to is one contract is going to equal 100 shares. Remember, team, we do not need a massive amount of money to go ahead and be able to buy these contracts. Just like when it comes out to, do I have $250,000 in the bank? Some people may say no, but could you still get a Lamborghini? The answer is yes. You could lease it for, let's say, 6 months to a year and spend $40,000 instead of $100,000. You still get the thrill. You still get to keep it at your house. You still get to, again, have that fun of, again, essentially owning a Lamborghini, but you do have to give it back at some point, and you are only paying, like 4 times less the price. So the thing is, that's the main difference we have here. And I just want to really embed this in last final time. Similarities: listed options as security, trade options like stocks. Options are actively traded in a listed market like stocks. Well, options are derivatives unlike stocks. Options have expiration dates. There's not a fixed number of options. There are with shares available, and stock owners have a share of the company with voting dividends unlike options. You don't have any power with options. You can't say, oh, I own shares of the company. You can go ahead and make votes on what the company does. On options, you don't have any power. You're going to be giving those back here very soon. But now let's get into the next point. Let's talk about how options really work. And this is the best way to really understand how options work. So think about it like this. This is our example right here. We have a house. And this house is worth $200,000. So it says, I'm interested in this house because I think it's going to increase in value, but I don't want to pay $200,000 right at this moment. So let's say you walk up to your neighbor, or you walk into a neighborhood you really like, and you see a house there and it's at $200,000, and you knock on the door and you say, hey, I really like this house. So instead of going to buy it, I'm going to buy a call option on this house that gives me the ability to buy this house for $200,000 within the next 2 years. So essentially what you'd be doing here is you would knock on this door, the person would come on out and say to yourself, hey, I like this house. Would there be any way that you would allow me to buy it for this price of $200,000 over the next 2 years from now? That person may say to yourself, no, that doesn't make any sense. Why would I ever again just randomly give you my house? What if it appreciates in value? Well, I want to do that. So what do you have to do as, let's say, the buyer? Well, you have to pay again. You say this. Well, you don't know if it's going to go up in value. How about this? I will give you $10,000 right now. And this $10,000 is telling me that, hey, you know what? You keep this no matter what. No matter what, you keep this $10,000. If your house appreciates in value, guess what? You're allowing me to buy it. If it doesn't appreciate in value, you get to keep my $10,000 no matter what. So our strike price is $200,000. Our option expiration is 2 years from now, which means that we can exercise this right. We can buy this house at any time if they accept that $10,000 payment, because they may say to themselves, yeah, I really don't know what this market's going to do. You promise you're going to buy $200,000 within the next 2 years. If it appreciates, absolutely. And you're giving me this $10,000 no matter what? Yes, sir. So that's what this is at this time. Strike price, $200,000. Option expiration, 2 years from now. That means if you show up 3 years from now, hey, the contract's not available anymore. You gave them $10,000 for nothing. So I have to pay $10,000 for this contract. Now, let's say over a year, it now goes up to $350,000. Just like in 2020, housing market prices exploded. Let's say over that year, it's now worth more. Well, I own that contract that allows me to buy this house for the price of $200,000, even though that the house is now $350,000. So I can exercise my option, my contract, meaning that I can buy the house for $200,000 because I also gave the current owner $10,000 to keep no matter what. That was the risk that I took. So the purchase price is $200,000. The asset value is $350,000, which means I made now a profit of $150,000. But let's go the opposite way. Let's go the opposite way and say, hey, This house now fell apart. Within 2 years, it's now down $150,000. So would I want to buy this house? With the value house at $150,000, I have no benefit buying it. I have no benefit of exercising my right. So I don't need to go ahead and buy this contract. So instead, what do? I just say to myself, you get to keep the $10,000. I lose the $10,000 because that's what I promised, looking for an investment out of it in the future. I lose my $10,000, but there's no reason for me to exercise that right. Because why? Because if I did buy it, well, I'm just going to end up losing $50,000 as the house is only worth $150,000 now. So that's a little bit of a different way that you guys can think about it. Now we definitely want to be thinking about, as it in a option, as it in contracts. So I just want to clear the air here. You're going to hear this a lot in contracts saying, oh, exercise. You have the right to exercise your contract. That just means to be able to buy or sell the contract. Just like you had the right to exercise buying that house within that 2-year time frame. And as long as, again, within that 2-year time frame, you want to buy that home, you can, because you gave that current owner $10,000. So exercise means to put into the effect the right to buy or sell the underlying financial instrument specified in an options contract. In options, trading the holder of an option has the right, but not the obligation to buy or sell options underlying security at a specific price or before a specific date in the future. Now, some of you guys may be getting a little confusing. So let's go ahead and let's break this on down and let's understand how we can actually trade an options contract. So if we want to break this on down here, I personally like trading SPX, but we could trade anything. We could trade SPY, we could trade Tesla, we could trade Amazon, we could do anything along these lines. So what do we need to understand? We need to understand that calls means that we are betting that we are going to be going on up. Puts are we are betting that stock is going to be moving on down. Stock, ETF, whatever. So let's think about an order here. We know that when we go ahead and place a contract, what these contracts are going to represent is usually 100 shares of whatever we're looking to buy. So our expiration is how much time we have until this contract becomes worthless. So this contract will become worthless at the end of March 17th, which is today, which means that if I hold this until, not Amazon, let's just go back to SPX. Let's go to SPX, let's go to call, and you can see March 13th. This is today. Or you can see March 13th. I was like, man, that doesn't sound right. Some contracts are same day expiration. Some contracts are weekly expirations. So SPX, as you can see, is March 13th, which is today, which means if I do not sell my contracts, if I do not get rid of my contracts by the time of 4 o'clock, guess what's going to happen? They become useless. Now, what you also need to understand here, team, is that we are not holding our contracts till the end of the day. We are essentially trying to buy our contracts, have them more valuable, and then sell them to someone else, sell them to another investor, sell them to another trader. It's almost a game of hot potato. And it's all coming down with a ticking time bomb as someone's going to have those contracts left at the very end of the day, which becomes worthless. So let's think about this in a little bit of an easier example, okay? So when we buy contracts, let's say we have the SPY. The SPY is the top 500 companies in the United States. This is, essentially the stock market. If I buy contracts, okay, let's say this is me. This is me right here. And I can buy a contract, and this contract right here is going to represent that I own shares at the price of $3.85. I buy contracts at $3.85, and guess what? Now the stock is at $3.88. So guess what I could do? I could put this up for sale, and I could say, hey, someone buy my contract. It's at $3.85. It's now at $3.89. So someone might say, ooh, this is a good contract. This is making this man money. I want to take it. And someone else says, hey, I'll buy that contract. So now you just got paid. You just got paid as the contract. You bought it at $3.85. You sold it at $3.89, right? $3.89. Guess what? That just made you money, which is great. And now this man right here, he has this contract. And this contract may again go up. And as it goes up, he bought it at $3.89. And maybe over time, we get up towards the price of $3.92. And now he says, hey, who wants this? It's now at $3.92. Who wants to, again, buy this one? And now someone else may say, hey, I'll buy this contract. And if he bought it at $3.89 and he sells it at $3.92, guess what? He has essentially 100 shares that has gone from $3.89 to $3.90 to $3.91 to $3.92. And guess what? He just made money. And he just dumped off this contract to this guy over here. But at some point, this contract is going to expire. And whoever is holding it at the very end where it expires is the person that's going to lose. So we are essentially trying to buy contracts and have them go up in value before our expiration date. Now, something that we need to understand, which is absolutely massive here, is going to be something called time decay. Now, time decay is going to be your biggest enemy when it comes to trading options. So there's time decay. Now, why is this a very big enemy? Because let's just say we have time going across the board here, okay? So everyone stick with me. We have time going across the board. Now, let's say we have value going across the top. Value is going to be how much your contract is worth. If I bought shares, let's imagine right here, this is going to be shares starting on off, not options. And I buy shares of SPY, so we'll say SPY, and we buy at $100. We buy at $100 on shares. Our shares move sideways. If the stock stays at $100, guess what? We lose no money, we make no money. We are sitting completely even. But the issue with options is the fact that as time goes by, so let's get rid of this and let's go with options here. So we'll just go with OPT, options. As time goes by, even if the stock stays at $100, the value of those options is going to decrease until we get to our expiration. Because remember, once we hit our expiration, they become absolutely worthless. They're worth $0. So you have to understand right now, when you buy in on a slow moving play, you better be making money as that stock moves. You need the stock to constantly be moving in your favor. Because if you buy in at the start of the day at $100 and at the end of the day it's at $100, you might say, oh, I'm breaking even. No, you're going to lose everything that you spent, your premium, what it cost you to buy that contract, that's what you're going to lose on. So you could lose $15,000 even if the stock moves sideways. And that's just because your expiration, your time decay starts moving down as time goes by. So what we really need, what you need is essentially for you to be able to make money is you need the stock or the ETF to move in your direction over time. So if we buy options at $100 and let's say it gets up towards the price of, let's go with right here of 110, if we had shares, we'd be able to make just out of, train of thought, let's say $1,000. We may not make, right, as much as we would of shares because it was a very slow climb and we are getting closer towards our expiration date. Which is why you guys probably realize my trades are very quick with the same expiration date. Take a look at my trades here. I bought in this morning at 9:38. I sold a minute and a half later. I bought in at 9:50 and I sold within 9:50. I bought in at 9:29 and sold at 10:30. And I'm up over $600 today. If you hold very long, your contracts are going to become less valuable. So let's think about this. You might be scratching your head now and saying, well, Deck, why don't we just make our contracts instead of the same expiration date? Why don't we make them a very far away expiration date? That would solve the problem, wouldn't it? Instead of having the expiration date of today, why don't we just make the expiration date of next year? This way, we have so much time for the stock to move in our direction. It's like we would never lose. Very true. But what you will realize is the farther away the expiration date, number one, the less money you're going to be making. And number two is going to be the more expensive this contract is. So we can also think about the strike price. And the strike price, team, what we need to understand is this is going to be in or out of the money. So let's go with SPY, okay? Let's talk about SPY. And let's say we want to buy one contract. We want to do a call contract. Call means I believe it's going to move on up. And we're going to do an expiration date of today. Now, when it comes to in the money, out of the money, or at the money, these are the three different points that you guys need to understand here. We have our strike price. If the price is at 388 and I put my strike price at 388, that means I am going to be at the money. The best way to trade options, and I'm going to say my best way to trade options, is to be out of the money. Out of the money means you're taking a little bit more of a risk, but it also means you can make the most amount of money and your contracts are going to be the cheapest. So the simplest way to be able to think about it is going to be by the end of today, March 13th, you want to have the strike price, you want to have this ETF, or let's say whatever stock you choose, above your strike. When you get above your strike, you're going to be able to make massive amounts of profit. So if we go out of the money, let's say we go to 392, the stock's at 388 right now, but I'm betting by the end of the day, it's going to get up towards 392. This is going to be the cost of our contracts. You could see 0.8, 0.8, 0.9. These are the cost of our contracts. What do you guys realize? What I realize is March 13th, today, I could buy contracts that are slightly out of the money, which means they're not at that current price yet. And you know what? This is going to allow me to have cheap contracts, and also it's going to be more risk, but also more reward. Because if I'm right, I get paid more. Excuse me, traders. So what everyone needs to notice here is you might say to yourself, well, Deck, that's more of a risk. But realize this, team. Realize it's one big kind of understanding of getting that perfect formula. If I do at the money, watch what happens with my contracts. If I say I want to do it at 389, they become more expensive. If I want to put my contracts already in the money, which makes them more appealing, I can go all the way down towards, let's say I want to go all the way down to 381. Now my contracts are even more expensive. So yes, you can put yourself at the money or in the money right away, which is going to make your contracts more appealing to sell them and be able to have other traders be able to take those contracts. But you're going to be paying a lot of money. Guess what happens? Let's go to strike price, guys. Let's go to strike price 389 right now. But let's change the expiration date from March 13th and let's change it to April 28th. April 28th, 389. Guess what? My contracts are more expensive. So what's the perfect formula? The perfect formula, and to me, is going to be doing contracts on the same day, which means it's going to be the most rapid, which means we could be able to make the most amount of money, and technically we could lose the most amount of money. And we could also do a strike price that is slightly out of the money. So if I'm doing a call contract, you could say 393. We would have $4 to run before we are in the money. Now, a lot of people may say, so Deck, I don't make any money until we get to 393. Nope, that's incorrect. You do make money the moment you buy in and it starts moving on up. But I thought you said it has to go all the way up to the strike price before you make money. Remember, traders, we are not holding these till the end. We are essentially just selling these to other investors. So if I buy in, let's say at 389, okay? I buy in at 389 and our strike price is all the way down towards, let's say the price, or all the way up, I should say, to the price of 393. And let's say this has now gone up towards 390. I bought it here at 389. I can sell it here to 390 to another investor who wants it. And this investor is going to be paying me for this 389 contract. So I am actually going to make the money from the difference from 389 to 390. So that is how, again, contracts are working. So we need to remember, the farther away the expiration, the more expensive it's going to be. And putting ourselves in the money, the more expensive it's going to be. But having ourselves a very far expiration gives us so much time to win. So we're basically paying for better odds. When we have a strike price that is very close in the money already, well, that's going to be more expensive. When we have a contract very far out of the money, that's going to be very inexpensive. But at the same time, we can make more money with stocks that are out of the money. Okay? So, how do I like to trade? How do we know what a good strike price is? So for me, what I like to do is I like to trade SPX. Now, SPX is the crazy version of the SPY. SPX is what leads the SPY. And you can see how SPY is all the way up to 3,900. So you could see all the trades that I made today on how I was able to make $600 was all from SPX. SPX, SPX, SPX. Now, the reason why I like SPX is because it's so much faster. It's so much quicker. We see more movement. We see more volatility. Now, I do not recommend any new trader to start off with SPX. I recommend new traders to start with SPY, with Apple, with Tesla, and be able to build up their contracts from there. But I know a big question that a lot of people always ask is, how do we know what the right strike price is? How do we know what the right strike price to pick is? And the best thing that you guys can do would be, let's say, one contract. I usually always start with around 5 contracts. And let's go with type. We could do a call. Expiration date, I always do today. And strike price, what I always like to do with our strike price team is always make sure you're around a 5 or lower. So if I did a call contract at 3,830, that is extremely expensive, $7,000 per contract. So what I want to do is look for contracts that are going to be right around a 5, 4, 3. That's what I'm usually looking at. Now, why do I like to do this? Because this shows me that I'm out of the money. When I have a contract that is around $4, that is again going to be, or again, it's actually a little bit more here, about $400. It's showing me that I'm out of the money, but not ridiculously far out of the money. It's within reason. If you do a call contract and you have 0.8 or you have like 0.10, you are so far out of the money, it's going to be very tough for you to be able to make a profit without being affected by time decay. You want to find the magic formula, which is going to be have your, again, last price be somewhere around 2, 3, 4, or 5. 2, 3, 4, or 5 is what you guys want to see. So let's do a small trade together here and let's see what we can do. So I want to take a look. Let's take a look over on the SPY. SPY shows me at this time that we again have a nice uptrend. This is what I see as our uptrend over on the SPY at this time. I'm going to keep my eyes peeled on this. And I would say to myself, all right, hey, I have at this time a total of $4,000 that I can be able to trade. That's what I have left on this day out of my settled funds. I think that there's going to be a bounce play when the SPY comes back up comes on down to 388.50 because we got a nice bounce off this purple line here. I could imagine a nice 388.50 mark here. So what I could do is I like to trade SPX, which does the same exact thing as the SPY, but we just make more money. So I would say, hey, I want to do 5 contracts, or we could just do 1 contract for this example. March 13th, because I know, again, the closer the expiration date, the cheaper the contracts are going to be. Also, close to the expiration date, the more money you can make. And I want to have a contract on my call contract here that is somewhere between 5 and 2. So let's say we want to do this right here, a 4. The way that you want to get involved on these trades here is you want to either A, do a market order, but I don't ever want to do that. I want to do a limit order by clicking the ask. The ask is going to get me in on the best price available. So I click the ask right here. You can see we actually just came on down towards on that 388.50-ish mark. We're starting to get a little bit of a bounce play back on up. But when I click the ask, that's giving me the best contract at this time. Gives me the best contract. And then guess what I do? Ask, buy, open. Now my order is now filled. And you can see, since I have 1 contract, this is going to come out to about $10 increments. If I had 5 contracts, it would be about $50 increments. Now, what's my game plan on this play? My game plan was, let's see if we can get a bounce play off this stock. But I see that I'm cracking this trend line. So I could get out on this play right now by going to limit order, click bid, and then sell close. And then when I click sell close, I could be able to get filled on this play and boom, I'm out of the stock because you could see it's cracking the trend line. Now, if I want to and say to myself, oh, wow, it's starting to fall, it's starting to crack, it's starting to get ugly. What I could do is go over to a put contract. Put contract, I'm obviously not spending this much money on a put contract. So I'm going to change my expiration date to something around 2.9, or excuse me, on my strike price to something around 2.9. And then I can go over to ask right here, click the ask button, go ahead to buy open. Go ahead to buy open. And now I can get filled with 2 contracts if I wanted to. I can get filled with 1 contract as I can look for it to start dropping. So my cost basis right now is right around the 380.20 mark. Now, if I want to make more money on this play, I can always go to my contracts and add more contracts. I could go to myself, hey, I want to add contracts. Now, again, I do that and my quantity goes up to 6 contracts. But now I'm up more money. Now I'm going to be making more cash more quickly. So I have my put contracts here. Now I'm up $133. Look how much money I just made in such a quick fashion. So I can go over to market order, switch on out to 6 contracts, click sell, and now again, I'm going to be able to make that profit. So $70 right here. So I just locked in $70, made back my last little loss right there, made $70. But the more contracts you have, the more money you make. And you guys can see how I was just up $133. So what did I do here? I lost again $40, made back a quick $70. Now that was off of what? 6 contracts? Could you imagine if I did 20 contracts? Could you imagine if I did 50 contracts and was able to hold these even longer and longer? And you might say, well, Deck, how much money do I need to be able to pay for these contracts? Well, that's only $300. It's $300 per contract. So the thing is, if I wanted to go ahead and say to myself, all right, Deck, well, let's see here. I have a $5,000 account. $5,000 divided by 300. I could go ahead and buy 16 contracts on this play. 16 contracts. You just saw how much money you can make off 6 contracts. It was $133 within a snap of a finger. Imagine if you could make, if you could do more and more and more. So that's where, again, things can start getting even crazier for us. We made a play. We saw the crack. We reversed. We went on down. And we can go ahead and add more contracts. 16 contracts, guys, is going to basically give you every 10 cents $160 move. So you can imagine if you go on a $10 or excuse me, a $1 climb, there's again $1,600 in profit off of a $5,000 account. So now you can see how your profits can generate much quicker in a very quick fashion here. But it is always buy open, sell close, contracts. Just again, doing some fun orders right here to make sure that you guys fully grasp what we have going on. But if I do a larger order, let's say April 4th, and let's say we do the same exact strike price, I'm not paying $8,000. Remember, it's this times 100. So I'm not paying $8,000 for 1 contract. I like paying $300 for 1 contract using a $5,000 account to be able to make, again, a couple $1,000s per day. Today, again, still up $600, now a little bit more, $600 and about $70 on the day from this little trade right here. So we can see how everything is being able to grow and grow and grow. Does this make sense to everyone? Everyone good with this at this time? Now, I know this might be a little overwhelming for kind of the first, brand new trader, but, it is absolutely crucial. So let's keep it going here, team, and let's talk about what else we have at this time. So let's bring over our settings here. And I apologize about my voice, guys. I know usually I sound like Justin Timberlake with a little bit of Justin Bieber with a little bit of Frank Sinatra. But right now, I got a little bit of a sore throat, and I apologize. So, little heads on up. This is all going to be a recap for you guys at this point that says, what is a call option? Call option says we go up, long or bullish. So whenever we do a call, you guys want to see this going on up, right? Call options are going to be financial contracts that give us the right to exercise these within that time frame, but not the obligation. You guys are going to read that a lot. And I know it always sounds more confusing than what it is. It means I can go ahead and I can sell these contracts, but I don't have to if I don't want to, which means I would just lose my premium. That's one of the biggest pros about contracts. If you guys spend $400 on 1 contract, the most that you can lose when the option expires is $400. You can only lose your premium. Does anyone remember the example of the house? What was the example of the house? The guy spent $10,000 on the house. And he said, I'm giving you $10,000. This is yours. But the thing is, if this house does not work out, if this house again cracks, if this house, goes down in value, I can't lose any more than $10,000. I'm not going to go buy a $200,000 house and then have it only be worth $150,000. So the good news about options is whatever you spend on your premium, $300, $700, $900, that's the most you can lose. So as long as you just hold it until your expiration date expires, that's the most that you can lose on this play. So we got our call examples right here, and then we have our puts, right? And puts are just going to be, we are betting that the stock is going to fall on down. So when it comes down to options, I hope everything that I've gone over so far is, rather clear. We're going to hit the brakes here today, and we'll get into a little bit more advanced stuff going into tomorrow.